Welcome to the Lever Trades podcast, where we take a deep dive into both foundation and advanced educational trading concepts. This video is not intended to provide investment advice. All content and opinions shared are for informational and educational purposes only. Trade at your own risk. All right, so today we're going to be diving into algorithmic and quantitative trading.
Okay.
And I have to admit, this is something that's always sounded intimidating to me, like Wall Street, robots, all that.
Right.
But it's something that we hear about more and more, and it's not just for the big guys anymore.
Yeah, it's becoming increasingly accessible, even for everyday investors.
Yeah, exactly. So that's what we want to unpack today.
Okay.
We've got some great material to pull from, really kind of get into the nitty-gritty.
Yeah.
So to start with, maybe just what are we even talking about when we say algorithmic trading versus quantitative trading?
I think the lines can get a little blurry sometimes.
Yeah.
But at a basic level, algorithmic trading is using computer programs to make trading decisions based on rules that you predefine. So it's like setting up a robot to do a task.
Right, just automatically does it for you.
Exactly.
Right.
Whereas quantitative trading, that's where it gets a little more, it uses more like the data analysis and math to identify those trading opportunities.
So it's like if algorithmic trading is saying, okay, when this stock hits this price, buy it. Quantitative trading is saying, what should that price be?
Yeah, exactly. It's like, you could think of it like baking a cake, right? You could have a set of instructions, that's your algorithm.
Right.
But quantitative trading is understanding like the chemistry of those ingredients, like what actually makes that cake rise.
I like that. So it's like algorithmic is the what, and then quantitative is the how to figure out what should be.
Yeah, exactly.
Okay, so that makes a lot of sense.
Cool.
So in our research, backtesting comes up a lot, which kind of gets into that quantitative side, I guess. What is that?
Yeah, backtesting is essential for both, honestly,
Really?
because you can backtest an algorithm, you can backtest a quantitative model.
Okay.
Basically, you're taking a set of rules, applying it to historical data, and you're seeing how it would performed. So you're kind of going back in time and seeing if this thing you've created actually works.
But isn't that, my instinct there is to say, okay, well, just because it worked in the past doesn't mean it's going to work in the future.
That is the biggest caveat with backtesting.
Yeah.
Right? So you always have to keep that in mind. Like, you're not using it to predict the future. You're using it to validate your ideas.
So it's just a piece of the puzzle. It's not like a crystal ball.
Exactly. Exactly. And one of the big things that can trip people up is what's called data snooping bias.
Data snooping bias.
It's kind of like when you're looking at a data set and you're only seeing the things that confirm what you want to believe.
Okay.
It's like saying, oh, look, this strategy worked amazing during like the dot-com boom.
Right.
Well, everything worked during the dot-com boom.
Right. So it doesn't mean your strategy's good. It just means it was a good time to be.
Right. Exactly. So you have to be very careful with backtesting.
But you said it's essential, so I don't want to throw it out completely.
Oh, absolutely not. No. You need to backtest. You need to understand its limitations.
Okay.
And you need to use it appropriately.
So what's an example of using it appropriately?
So let's say you've got this hunch, right? You think that if you buy a stock after it drops 10% in a week, that's a good strategy.
Okay.
Backtesting lets you simulate that over, say, the last 20 years of market data.
Okay, so you can see how many times it worked versus how many times it tanked.
Exactly. And then you can start to tweak it. You can try different variations.
Sure.
You can look for those biases. Like, am I only picking winners because I'm looking at a very specific time period?
Right.
And it helps you refine that strategy.
So it's like a testing ground before you actually put real money on the line.
Exactly. Exactly.
Okay, that makes sense.
Yeah.
So we've backtested our strategy. We think we've got a good one. Now we got to actually, pick what stocks we're going to use this on, I guess.
Right. And that's where those quantitative factors come in.
Okay, we touched on those earlier, but maybe we can dig a little deeper.
Yeah, so these are basically the characteristics of companies or stocks that have historically been shown to drive performance. So you've got things like momentum.
Which is like how much it's going up or down.
Yeah, like is it trending upwards? Is it trending downwards?
Okay.
You've got value, which is trying to find those underpriced companies, like hidden gems, quality, looking at how well managed a company is. Are they profitable?
Okay.
There's a whole bunch of these factors.
So these are things that then I would imagine get plugged into the algorithm.
Yeah, you can use them in your algorithms. You can use them in your quantitative models.
Okay.
And they kind of help you filter and identify those opportunities.
So it's like, instead of just looking at the whole entire stock market, you can say, I'm only interested in, tech companies with high momentum or whatever.
Exactly.
But these aren't like foolproof either, right?
No, and this is where it gets tricky because these factors can change over time.
Okay.
What works in one market environment might not work in another.
Right. So it's not just like a set it and forget it kind of thing.
Exactly. You got to be adaptable.
Okay.
And you got to stay informed.
That makes sense.
Yeah.
So, okay, we've got our strategy, we've got our factors, we think we're good.
Yeah.
How do we actually, implement this in the real world?
All right, so this is where things start to get even more interesting, where the algorithms come in.
Okay, so let's talk algorithms. Okay, so algorithms, this is where I feel like it gets really complicated.
Yeah, it can seem like a black box, especially when people start talking about, AI and all that.
Right, like, are the robots going to take over Wall Street?
Right, exactly.
But let's try to demystify it a little bit.
Yeah.
What are we talking about when we say algorithms in this context?
So at their core, algorithms are really just sets of instructions.
Okay.
It's like a recipe for the computer to follow.
Okay.
And in trading, those instructions tell the computer, when to buy, when to sell, how much.
So basically, we're taking that strategy that we back-tested, we're taking those quantitative factors, and we're turning it into this set of instructions.
Exactly.
And the computer just does it automatically.
Exactly. And the beauty is they can do it much faster and more efficiently than any human could.
Right. We're talking like milliseconds here.
Exactly. Which is crucial in the markets because even a tiny delay can mean missing out on an opportunity.
So that's where the high-frequency trading comes in, but we'll get to that a little later.
Right.
So, okay, algorithms, got it. But then there's this whole other layer of machine learning.
Right. And that's where things get even more interesting.
Yeah, because that feels even more like, I don't know, futuristic.
Yeah. It's kind of like taking those algorithms to the next level.
Okay.
So instead of just blindly following instructions, machine learning algorithms can actually learn and adapt from data.
So it's like they're constantly evolving, getting smarter.
Exactly. And that's really powerful in a field like finance, where the landscape is always changing.
So give me an example. How would you use machine learning in, say, like a value investing strategy?
Okay, so let's say you're looking for undervalued companies, right? Traditionally, you might use those classic value metrics.
Right, price to earnings ratio, all that.
Exactly. But with machine learning, you can feed all that data plus a ton of other data into an algorithm.
What kind of other data are we talking about?
Oh, it could be anything. News sentiment, social media trends, even weather patterns.
Weather patterns? What does that have to do with stock prices?
Well, you'd be surprised. The algorithm doesn't assume anything. It just looks for patterns and connections.
Interesting. So it's like the machine is seeing things that we humans wouldn't even think to look for.
Exactly. And it can find relationships between seemingly unrelated data points.
Okay, so it's like having this superpowered research assistant that can analyze everything.
Right. And then it uses all that information to identify those potentially undervalued companies that you might have missed otherwise.
Wow. Okay, so that's pretty amazing, but I'm sure it's not all sunshine and roses.
Right. There are challenges with machine learning, too.
Like what?
Well, one of the big ones is data quality.
Right, because if you're feeding it bad data.
Exactly. Garbage in, garbage out, as they say. And then there's the issue of interpretability.
Interpretability, what's that?
So some of these machine learning models, especially the really complex ones, can be kind of like black boxes.
Okay.
They give you an output, but you don't really understand why or how they got there.
So you might be making money, but you don't know why.
Exactly. And that can be a little unnerving for some people, especially in finance, where you want to understand the risks involved.
Right. That makes sense.
But even with those challenges, there's no doubt that machine learning is having a huge impact on trading.
Yeah, it sounds like it's really changing the game.
It is, and it's only going to become more prevalent in the years to come.
Okay, so we've talked about algorithms, we've talked about machine learning.
Yeah.
And now I kind of want to circle back to something you mentioned earlier, high-frequency trading.
Ah, yes. The world of speed trading.
The Wild West.
Right. That's one way to put it.
So what exactly is high-frequency trading, and why is it so, I don't know, controversial? Okay, so high-frequency trading, it's all about speed. Right? Like making trades faster than we can even blink.
Basically, yeah, we're talking milliseconds here, even microseconds.
And they're doing this to take advantage of, like, what, tiny price differences?
Exactly. These little discrepancies that pop up for a fraction of a second.
And they can make money off that.
Oh, yeah. It's all about volume. They make tons of these tiny trades, and it adds up.
I guess that makes sense, but it also sounds incredibly risky.
It definitely is. Not for the faint of heart.
So to wrap our heads around all this, I mean, we've covered a lot of ground: algorithms, backtesting, machine learning.
Quantitative factors, high-frequency trading, the whole shebang.
Yeah, what would you say are like the key takeaways for someone who's maybe just starting to learn about all this?
Well, I think the biggest one is that this is the future of finance, like it or not.
It's not going away anytime soon.
Exactly. So even if you're not going to become a quant yourself, it's important to understand the basics.
Right, like how it works, what the risks are.
Exactly, because it's impacting the markets whether we realize it or not.
That's a good point. And then the other thing I keep thinking about is just how much data is involved in all of this.
Oh, yeah, data is king in this world.
And not just like stock prices. I mean, you were talking about using weather patterns and news sentiment and
social media, everything's fair game.
it's kind of mind-blowing, like trying to make sense of all the noise.
Well, that's what these algorithms are designed to do, find the signal in the noise.
Right, but then there's that whole black box problem we talked about.
True, it's not always clear how they're making those decisions.
Which is a little unnerving, I have to admit.
It's a valid concern and something to be aware of.
So as we kind of wrap up here, what would be your, I don't know, parting advice for our listeners?
I'd say stay curious.
Okay.
Don't be afraid to dive in and learn more about this stuff, even if it seems intimidating at first.
There are resources out there, right?
Tons. Online courses, books, communities, you name it.
So find your people, those who are also interested in this world.
Exactly. And never stop learning, because this field is constantly evolving.
That's great advice. Well, on that note, I think we'll wrap up this deep dive.
It's been a fun one.
It has. I've learned a lot. So thank you for sharing your expertise with us.
Anytime. Happy to help demystify this crazy world.
And to our listeners, we hope you enjoyed this deep dive into algorithmic and quantitative trading.
Until next time.
Happy investing, everyone.